CMQ Investors, this is Chris Franco. Charlie Munger says that the game of investing is one of making better predictions about the future than other people. In this episode of the CMQ Investing podcast, I share a framework that I use to make predictions about the future cash flows of businesses that I'm considering investing in. I also explain why I avoid investing in businesses where I believe their futures are difficult to predict. This is one of those episodes that I've kind of had on deck. I've been told I need to release it because people really enjoy it. So I hope you enjoy it as well. And if you do, I hope you'll follow the podcast on Apple Podcasts and Spotify. And without further ado, let's get to it. I was thinking a lot about this from an analogy here of machine learning and making a predictive model and doing the same activity in our brains when deciding to invest in a company or not. Here's what I mean. There are certain characteristics that a business needs to have to give it a high probability of long-term success. And some of those examples would be, a sustainable barrier to entry, a pricing power, a well-known, established, and loved brand, a large, sticky customer base. These are all things that if a business has those characteristics, it doesn't guarantee future success, but it's certainly, you can make a better prediction about the future based on, or if the business has those characteristics. And there's more than just that. There's an episode I've done called the Bad Business Checklist. And here's how I came up with this, and then I'll share some specifics that relate right back to what I'm saying. I went through every single Berkshire Hathaway annual meeting, the Q&As with Charlie and Warren. And I took every instance I could find where either Charlie or Warren talk about what makes a good business good. And I made a spreadsheet with all those characteristics. And then in the second column, I wrote the opposite of those characteristics. So that gave me, what I call the bad business checklist. If the business has these negative traits, then I should probably stay away from it. And rarely are you going to find something where it checks all the boxes, whether they're the good business or the bad business. But it does create a useful framework anyway that I think is helping me avoid bad investments. And so I started to sketch this out in one of my little mind mapping tools, and I'll try to share this. You could go to my Twitter page, actually. I've got one example of this. It's Chris Franco on Twitter, ChrisFranco. So, what characteristics would a business have to be more likely to fail or do poorly in the long term? So let's start off with, it's very capital intensive. It has a low return on invested capital. The management is a little sketchy. The customer churn rate is very high. And a good example of this would be like a meal kit company versus Costco. Like if you're, what's the Blue Apron? Blue Apron has a tough time keeping people on for a long time, whereas Costco doesn't. And there's a huge advantage when you're in the Costco position. It's so much more profitable to retain existing customers than to go get new customers. And so, if you can get them in the door and they stay there, then you just need to focus on improving the cost to bring them in the door. That's what I do for a living. So that's why this is very obvious to me. If the business is in a dying industry, doesn't mean it can't succeed, but the probability is very low, and I wouldn't want to bet on that. The odds are not in my favor. An example, and I know probably none of you need this example because it's so obvious, but AMC. If you look at AMC's business, it's a great example of what a bad business looks like. It's a dying industry, no pricing power. All the trends are not in the company's favor. You could argue that the management's a little sketch or just a little bit, self-serving, not as long-term oriented as you'd want to see. Go on and on and on. But at the end of the day, why would you want to bet on that kind of a situation, right? Like those characteristics make it likely that the prediction is not going to be, I would predict it's not going to be very positive versus if AMC had a tailwind, if they were in a growing industry with a tailwind, if they had untapped pricing power, if there was, low capital requirements, they have great return on invested capital, management is just a bunch of all-stars, a habit-forming product, those would be characteristics that I'd say, yes, those give me, I think the likelihood of a positive outcome is far greater. I'd make that prediction. So it's very much, and I don't know if I'm making a great, I know the analogy is on, but I'm just thinking of it out loud, but it's like a deep learning model where, you're feeding it data, and based on, a lot of things that even the people that make it can't see, it's spitting out a recommendation to you that tends to be better than what a human being would be able to come up with, and faster. And again, this is not something that we need to go down this path too far. But I think, think of it like your checklist for buying a business or an investment. You're trying to make a prediction about the future. And so if you can find what characteristics have to be there to give it a chance of success long term, and you refuse to buy anything that doesn't share those traits, well, that's a pretty sound approach, right? Like if I'm like, a business has to have these things, and let's use Charlie and Warren. They talk about 4 things specifically. 1, can they understand the business? Is it in their circle of competence? 2, is the management, high integrity and talented? Are they talented and of high integrity? 3, does the business have some intrinsic quality that gives it a durable competitive advantage? And 4, is the business reasonably priced? Because even a perfect business is not worth an infinite price. You want to have a margin of safety, so you need to get the price right. So if those 4 things are in place, that eliminates a lot of room for error. It doesn't guarantee that they'll be right, but it's certainly, that's an example of having a set of a filter, if you will, that can make the game of investing a lot more dependable for you. Your results are more dependable. Your process is very clear, and you're not going to make a lot of terrible decisions if you can stick to something like that. Doesn't mean you won't make any, but so these traits we're talking about, what I find, and it's been interesting because I've had some questions come at me. There's we have a Substack, it's CMQinvesting.substack. We've got a really engaged audience now. And I share things there that sometimes we talk on the podcast. Sometimes it's just more for like reading, but you can sign up for free, cmqinvesting.substack.com. And one thing though, when I think I had a conversation on Twitter with someone who's, his name's Edwin Dorsey. He's got a very popular Substack in finance called The Bear Cave. So check that out, The Bear Cave, just a friendly shout out. Because I'm not trying to call him out, but I'm just sharing the story here. This was probably a few months ago on Twitter as I started to kind of, hey, I should start to chat on here. He said something like his portfolio is 75% Twitter. And, I followed up and said, I think that's a bad idea, because he was asking, what do you think to anyone? And I owe kind of like my full explanation here, but this framework that I just went through about the characteristics of a good business versus a bad business, immediately Twitter, like I don't waste time on Twitter. Because of the following. For starters, I don't want to be invested in a business that doesn't have at least a chance of dominating its industry or its space, because that's where in all likelihood, the company that has the dominant position has the best return on invested capital. It's creating the most value for me as a shareholder, in all likelihood. And Twitter, in the space that they are in, they are a long distant second or third from Facebook. I mean, I'll tell you the exact numbers. It's massive. People with this Facebook news, they're acting like Facebook's in big trouble, and, Snap had great earnings. Snap, they make peanuts compared to Facebook. It's not even, it shows you how little people really look into this. Like even the professional analysts on TV, how brutally uninformed they are, which should be encouraging to everyone else who's listening or watching this, because all of us are capable of becoming as knowledgeable as we need to be to make a wise investment. Not saying it's going to happen overnight if you're new, but there's no special thing. It's just a curiosity, discipline, practice, and being independent in thought. But let me share this. I have pulling up this watch list I have here because I was comparing Facebook to Twitter, Pinterest, and Snapchat. Now, when we talk about the differences in size and just success, all these 4 companies are all in what you call the paid social advertising. They're in the digital advertising business, but it's specifically social media advertising. Revenue. So Twitter does about $5 billion in revenue. Great. Snap does $4.1 billion in revenue. Pinterest does $2.6 billion in revenue. Now Facebook does $118 billion in revenue. We don't have to be math geniuses to know that Facebook is just killing Twitter. But what else can we look to Twitter and see, going back to this thing with Edwin on Twitter on why I think owning so much Twitter is crazy. Twitter doesn't have those characteristics we're talking about that make the future success more predictable, specifically future cash flows. We want predictable future cash flows. So Twitter, return on invested capital, I mentioned that's a metric I really pay a lot of attention to. Facebook's return on invested capital is 28%. And we want to look at return on invested capital relative to WACC, which I'm going to sound like an idiot for a second here, but that's fine. I don't mind being honest about forgetting the exact meaning of both C's. WACC is the weighted average cost of capital. And so you want the return on invested capital to be more than the weighted average cost of capital. That implies that there is money being made with the money that's being put in or invested in the business. They're creating value for shareholders. So, as I said, Facebook 28% return on invested capital with a 28% with a weighted average cost of capital of 7%. Twitter has a return on invested capital of 1.7% and a weighted average cost of capital of 7.2%. So when you look at the two businesses in terms of how they're doing at creating value for shareholders, I mean, it's not even a question. You would never want to touch Twitter. And so when I see Edwin's a smart guy, like I'm not taking anything away from him. This is, if he's listening, I don't know if it's that big of a deal, but I don't think of people I talk about as strangers or like they're not humans. I think of these as real people, and I want to be, look, we can all get it wrong at times. But this is just a good example of like where you could easily avoid a lot of problems by just internalizing what I'm talking about here with, the characteristics that you need to see in a good business. A great business is going to have a high return on invested capital. That seems to me like a no-brainer. A bad business is not going to have a good return on invested capital. They might actually be deleting value instead of creating value for shareholders. And that's what it appears that Twitter is doing just based on those two metrics I mentioned. Now, another one I like looking at metrics-wise is free cash flow per share. The reason I do this, by the way, I have to give credit where credit's due. Jeff Bezos, his shareholder letters are also a treasure chest, not like on the Buffett level, but they're really good. If you ever go back and read every annual letter he's written, which I have because I'm a loser, because I'm a nerd. But in terms of long term, Jeff Bezos is big on the long term. That's a big part of Amazon. There's an episode of the podcast called like something about long term thinking and Jeff Bezos. You'll know it when you see it. But Jeff Bezos talked about early on, they want to measure success by free cash flow per share, which I thought was interesting as a metric to look to as a success. Excuse me, as I'm trying to pull up the quote and talk to you guys, so I sound like I'm not all the way there, but here we go. This is from 2005. Bezos wrote, "Our ultimate financial measure and the one we want to drive over the long term is free cash flow per share." I'm going to tweet that right now just so I remember this moment. And I'm going to leave this, by the way, this episode is going to go up as is because that's the request, the feedback I've gotten from some of you. So I'm going to stick to that. I think it was pretty good feedback, actually. It was just that people want to feel like they're just hanging out with you and they're getting a lot of information. So some of you I know like the shorter episodes, and it doesn't mean we're not going to do those anymore, but I want to keep trying new things as long as we can because that's how we're going to grow. So free cash flow per share. Let's look at these two companies, Twitter and Facebook, through that lens. So Facebook, $14.06. That's their free cash flow per share. Twitter, 41 cents. Crazy, right? I see Ilias just joined. Ilias, what's up, man? Yes, the reason we are here is because Instagram Live would not let me go live. It said there was an issue with the connection, which I assume is a bug on Instagram. So I wanted to record something fresh, and I like having even a small audience. So I also want to make sure we start building YouTube, so this can't hurt. We're talking about Facebook and Twitter and why Twitter is like such a no-brainer, don't buy me stock, yet very smart people in the investing space have other reasons, that I think are less objective for thinking that, they're projecting this great future that I think is divorced from the reality based on, what we can see in the fundamentals of the business, as well as just the industry. Twitter, as I said, in digital advertising, I I allocate considerable sums of money to these platforms on behalf of major brands. We don't go near Twitter. Not that it's not just because Twitter's bad or something, but it can be effective for certain industries or certain verticals. But in general, if you have more scale, like there's so much scale on Facebook and Instagram, and the quality is there that, you're going to exhaust. It's like Buffett and Munger talk about with it. If you have a great opportunity, you load up on it. It's the same thing with, the smart growth marketer, digital advertiser, is not trying to be spread thin. They're trying to find what can work and load up and double down, triple down, and quadruple down, and, harvest while the sun is out. So other metrics here to keep in mind with, talking why Twitter is such a piece of, what. Let's see what else. Gross profit margins are strong, but Facebook's are better. When I look at gross profit margin, I only look at that as an indicator among companies in the same category. Because the company with the best gross profit margin, that could indicate that they have some sort of competitive advantage. So it doesn't mean that by itself is a good metric. It could be a vanity metric, but Facebook has a gross margin of 81% versus Twitter's, which is 64%. And remember that Facebook is making about 25 times the revenue per year than Twitter. So it's night and day. Then we could look at things like return on equity, which Facebook crushes, Twitter's is negative. They're almost at a similar price to book right now, which is crazy. But the market just overreacted. And it just, when people are like, hey, Pinterest could be a great opportunity. Yeah, if you don't know the space. If you just think that, hey, there's Facebook's weak, so therefore one of these other companies is going to gobble up a lot of market share. That's very limited thinking, in my opinion. I would have thought the same thing 5 years ago. But, as I've internalized these lessons here, the likelihood of Twitter having this amazing turnaround, and not just a turnaround in their business, but then, Facebook has 2.7 billion daily actives or somewhere along those lines. Twitter it's in the hundreds of millions. It's just, they have to fix so many things and catch up on so many levels. It's not probabilistically likely going to happen. It's not likely it's going to happen. And, I've learned from the best investors think like the best bettors, the best poker players, the best, people that bet on horse racing. And, Buffett talks about the pyramidal system all the time. So does Charlie Munger as the best analogy to the stock market. You don't want to pick the horse that everyone thinks is going to win. You want to pick the one that can win, that the odds are, against, because you get a much bigger upside. You want to see something that the others don't. And if others don't see it, that's going to help in terms of the price that you pay. So when I look at Twitter, I get that people could say, hey, I think this is that, that horse that could win the race. I mean, think of it like the horse is 4 laps behind the person in the lead. So for Twitter to catch up, it's just so unrealistic. Like I said, anything can happen, but I'm not putting my money on that, right? Like that's how you have to think about it. Like I'm not going to put my money on that. There's better things that I could bet on that I think, again, are more predictive. And going back to these characteristics of businesses, what does Twitter have that would indicate that it's a super strong business just based on the characteristics that Buffett and Munger have laid out over the years? I mean, pricing power, no. Strong brand, it's not a not strong brand, but they can't put Twitter on a t-shirt and start a fashion line. Whereas a truly strong brand almost can. Like Apple could put that brand on anything and they would probably sell at a premium. That's when they talk about a really strong brand. Sticky customer base and large, yeah, but nowhere near Facebook. So it's, you could argue they're failing. In isolation, it's big and sticky, but in context of its competitors, it's small change. And that's another reason why we have to look at businesses in comparison to other businesses in that industry. Because if you only look at it in isolation, you can tell yourself a great story. But at the end of the day, if it's not it has to win, right? Like it has to beat these other companies for you to really, nothing's a guarantee, but to have a better chance of doing well. You want to own the winner, right? You want to own the one that's going to crush it. You don't want to own the second or second place can be okay, but ideally you want to pick the winners. It's hard to do. Most people shouldn't do it, but there are certain characteristics we can look to, and Twitter doesn't have any of those things. And so, as I said, this whole kind of framework here that I'm outlining very non-linearly, it saves you a lot of time because I don't have to waste a lot of time like intellectualizing Twitter, because Twitter I love the service. I love using it. I've been on Twitter since like 2009, but that doesn't mean it's a good stock. And that's, again, why you hear me say this, but that's why I hate that stupid thing that they're pushing now. Buy shares of the companies you love. I love Twitter. Twitter's great. but I don't want to invest in it. That wouldn't be a good way to go about investing, because there's a lot of companies I love that are not run as well as I would want a company to be run if I'm going to invest in it. They're not going to do how is Twitter going to serve you as a shareholder with a return on invested capital of 1.7%? If you're a Twitter bull, how is a company that has a return on invested capital of 1.7%, how are they going to serve you as a shareholder? I mean, it's an honest question. I think these are the questions I like asking out loud, because, it's some of this stuff, it doesn't require as much thinking as I think people think it requires, because it's really just getting to the simple essence of this stuff. I'm not trying to say it's easy, because it's not. You have to tune out a lot of noise. You have to really, just because I'm saying it doesn't mean I'm right? I could just be an overconfident idiot, and I'm not, but I'm very aware. Anytime I'm feeling certain in my assessment of something, I try to kick the tires as much as I can. I was going to say fact check, but I kick the tires on my own ideas as much as possible. But again, if we know the big ideas and we understand how it all fits together, there's nothing that indicates Twitter has a bright future. And I've also heard Buffett and Munger saying it's a great reference point here. You don't want to own a business with a lousy track record and a bright future, because again, can a business turn themselves around? Sure. But what's the base rate? How many businesses are bleeding money or just doing terrible? I don't mean bleeding money, but just like failing to create real value for shareholders. How many of those businesses have been able to turn things around? I bet it's a teeny tiny percentage. So sure, that teeny tiny percentage can be your hope, but the base rate probability it's not in your favor. And, we know that our brains are bad at probabilistic thinking. It's unnatural. But when you start to force yourself to think like that, you start to see a lot of paths you just don't want to go down. As I said, anything can happen, but I'm not looking to bet on a miracle. I'm trying to pick something that I think is as close to a sure thing as it can be, that hopefully the rest of the market doesn't agree is a sure thing. That's where I am with Alibaba right now. You hear me talk about this. Could I be wrong? Absolutely. But the framework in place to make Alibaba potentially a great investment, it's all there. You have a business with over 1 billion active customers. That's just their commerce business that is not failing by any stretch of the imagination. They got hit with some regulatory things but it's a cash-rich business with a strong balance sheet, extremely strong brand, incredibly sticky customer base, low churn, great business, like low overhead on their business model, huge opportunities for future growth through the cloud computing business, as well as international expansion and just the growing population in China. And I don't know quite how this would work, but if the savings rate in China goes down at all and it's very high, the purchasing power and just the general, like the amount of money people might spend as consumers in China, if that goes up, well, Alibaba is guaranteed to capture a very meaningful percentage of that. And that's just, it can't help but grow. And if Alibaba was, not making money, or if it was, didn't have any cash or anything like that, that wouldn't make it a good pick, but it checks all those boxes. The thing that people are betting on or fearful of is the, what will the relationship with America and China be? I know I can't predict that, but I use a very basic model of incentives. And I think the incentives for, let's just say, the United States and China, I think the incentives for our countries to get along and cooperate economically will overweigh any, in the long term, that'll persevere. That itself gives me, I feel like I can make a better prediction, because at the end of the day, both countries care about prosperity and also trying to be, the top of the world stage. And so if you're China, for example, why would you want to hold back a company that could be one of the largest companies in the entire world? A company that makes a lot of money, that therefore, there's taxes that are paid to the government, right? Why would you want to hold that back? Because the things that the government did hold back with Alibaba are things that they were doing that wouldn't be legal here. It was like the regulation wasn't, in my opinion, unfair. The regulatory watchdogs found something that Alibaba was doing that was anti-competitive, and they told them they can't do it anymore. I don't have a problem with that. I didn't take that as like, oh my God, the government, they're putting their thumb down on Alibaba. And then people bring up this Jack Ma thing. They silence Jack Ma. I'm not disputing that, but Jack Ma has not been running. It's like Bezos is in a rocket ship and with his girlfriend. Jack Ma stepped down from Alibaba. He's He's not their acting CEO. Jack Ma, when did he step down, actually? Okay, chair of Alibaba. He stepped down on October 1st, 2020. But people say, look what they're doing with Jack Ma. It's like that. Okay, that's not great. Hopefully he's okay. But he's not the acting CEO or chairman of Alibaba. So it's not the same thing as if we didn't hear from Zuckerberg, right? Like the government silenced Zuckerberg, because he's actually running the company. Ma is not. Ma was just speaking his mind. And I imagine he got a phone call that says, you better keep your mouth shut or you're not going to be talking to anybody if you keep on saying what you're saying. He goes, oh, okay. Sorry, my bad. But again, people who you think are informed, but they say things like, well, look what they're doing to Jack Ma. It's like you clearly know nothing about Alibaba if you think that he still was at the company. But anyway, not to get too worked up on that, but shout out to Jack Ma, by the way. We'd love to have him as a guest in the podcast. He can talk about whatever he wants on our podcast, which, by the way, if you're not subscribed or following, you can do that for free. It's on Apple Podcasts and Spotify. Just hit that follow button. It takes a couple seconds. And that way you will get all the episodes in your feed as soon as they're released. And we will be best friends for life. Also, remember, none of this is investment advice. I'm just sharing my thoughts and feelings and opinions and ideas. And it's great to have a place to do that.